Point of entry is very important. So if you got in at those entry points, your average price is in the 30s somewhere. So yes, you've given back profits, but you're not losing. And frankly, if you look at the bull trend since the 2015 low, especially in gold, I mean, there were plenty of times you had major pullbacks, and yet they weren't the end of the bull market. And you're glad at that point in time when you saw those pullbacks, some of which we did call, that you got in at a good price. So right now the issue is we got too many people sucked into the market based on simple price chart stuff, breaking through the $50 range and gushing, and therefore waking people up about the new reality in silver. They're getting hurt, I admit. Question is, are we going back to 50? And I'll give them about 24 to 48 hours to prove the case.
Silver and gold investors are watching the recent correction closely, wondering whether it signals the end of the bull market or just a pause before another move higher. Volatility has shaken confidence, especially among newer investors who entered after the dramatic silver breakout. Michaeloliver, a respected market analyst known for his momentum-based forecasting approach, argues that the current weakness in precious metals should be viewed within the context of a much larger long-term bull trend. He explains that investors who entered silver at strategic momentum signals over the last several years remain in strong positions despite recent price declines. According to his analysis, many traders were attracted to silver only after major price breakouts. Similar pullbacks have occurred repeatedly throughout gold's bull market since 2015, yet they have never ended the broader upward trend. Instead, they often created opportunities for disciplined investors who understood the larger market structure. Now, we present the clips from Michaeloliver's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you and enjoy the video.
Point of entry is very important. If you got long silver because it broke out of a silly price range, a 50-year range, and only then did you get long, $55 or 60 or 80 or whatever, then you're suffering. You break even at best, or, especially if you bought it in the 60s or something. And if you bought it at 100, you're really hurting, okay? That's because you entered at a bad time. Our buy signals based on momentum factors just over the last couple of years were $25+ in 2024. March of 24, we put out a major signal saying we're going to go up and take out that $30 high that occurred in 2020. Okay, just mark that down. 25 to 26 zone was a buy. Next level was 35, June of 2025. And our final long-term buy signal was at $56 when silver's close in November last year broke out above gold's relative valuation chart, where silver had been confined. It broke through the top of that range. So if you got in at those entry points, your average price is in the 30s somewhere. So yes, you've given back profits, but you're not losing. And frankly, if you look at the bull trend since the 2015 low, especially in gold, I mean, there were plenty of times you had major pullbacks, and yet they weren't the end of the bull market. And you're glad at that point in time when you saw those pullbacks, some of which we did call, that you got in at a good price. So right now the issue is we got too many people sucked into the market based on simple price chart stuff, breaking through the $50 range and gushing, and therefore waking people up about the new reality in silver. They're getting hurt, I admit. Question is, are we going back to 50? And I'll give them about 24 to 48 hours to prove the case. Okay. So we'll see. The stock market, let's talk S&P. If you go back, there was about late last year, early this year, there were about 6 months capped off. Every time it would get up to like 69.50 or something like that on the S&P. One time it traded 7,000, but there was a zone of constant selling around 7,000 or just below it, a distribution zone where somebody said, I don't care if it's going, I want out, I'm getting out. And they kept selling at the same level. Well, the war news hit and everybody thought, oh my gosh, the end of the world, so let's sell it. And you went down and took out the lows of that range briefly for like a week or two and then shot up through it. We thought that rally would occur and that you would not stop at a flat high like that. And sure enough, the war sellers got skewered. Okay. It went up to 7,600. Now we've dropped down into the 7,200s now. We're still well above the top of that range, which was roughly 7,000. We don't think the S&P is going to suffer anything sharp and sustained until we get into next quarter and at levels that are below here. We think you may have seen the high, but I don't think you're going to see some disastrous puke now. And probably the price chart guys are looking at that 7,000 zone and thinking, oh boy, I'm going to buy it there. Fine, let them do it. Next quarter, if you get down much under that 7,000 zone, we're going to provide trigger numbers that say, uh-oh, you've stepped on a landmine. But right now, you're not in danger in our assessment of anything called a collapse in the stock market. I think you may be topping, and certain sectors may appear to be dropping sharply, like the semis, maybe NVIDIA. But there's enough wherewithal, we think, where the market won't really implode in any like high double-digit percent, like 30, 40% or anything like that. I think you're in a laborious topping, and you're probably now headed down, but I don't think it's the kind of thing that gets headlines and where it's sell everything type notion. That concept is false historically. You go back a century, study stock bear markets.
The discussion highlights an important lesson for investors. Entry points matter just as much as long-term conviction. Those who accumulated positions during earlier momentum signals have experienced significant gains even after the recent correction, while late entrants are facing much greater pressure. This distinction helps explain why market sentiment can vary so dramatically among participants holding the same asset. The analysis also extends beyond precious metals to the broader financial markets. While concerns about geopolitical tensions and economic uncertainty continue to dominate headlines, the outlook suggests equity markets may not be on the verge of an immediate collapse. Instead, the evidence points toward a gradual topping process rather than a sudden crash. This helps clarify the broader market takeaway: fear-driven selling does not always lead to long-lasting declines, and investors who focus only on short-term price movements may miss the bigger trend developing beneath the surface. Now, let's get back to the interview.
Most of the congestion zones we've seen in what has been a layered bull market in silver and gold for the last, handful of years, even 11 years since the 2015 low. Anytime we get a range-bound situation and you break out of it, especially in gold, and you surge, everybody always analyzes, quote unquote, that it's got to go back and sit on the old resistance, the old highs of that range, and then turn up again. And it never does that. It builds a range, breaks out of it, but it never seems to go back to the top end of the prior idiot range. And a lot of people are now talking $3,500 gold to get back on top of the prior range. Okay, well, all I can say is the clock is ticking, and 3 strikes and you're out. You better make this one work. You better hit a home run on the downside, because otherwise the bull forces are going to take over and you're going to come out of this congestion zone. And we argue that as you come out of this congestion zone, assuming we're right in this analysis, it will be rapid. It won't take 3 months to get back up to the highs. It might take 3 weeks or something. So the issue right now is bears are in charge. Let's see it. And their clock is ticking. Gold, the mama metal, the mama monetary metal. Silver's the, poor man's gold, okay? Silver always moves with gold, major trend swings, always. But how come when gold kept making new highs, 1980, 2011, 2020, took out the 2011 highs, lived up there, silver was still capped at 50. Copper wasn't capped, lead wasn't capped, gold wasn't capped. How come silver was confined in this little box? Well, there's arguments that, and evidence that it was restrained by certain arbitrary forces from the outside trying to keep it capped. Well, they failed. And whenever a market makes a mistake, like staying way too high for too long or way too low for too long, when it compensates for it, it often goes berserk, which it doesn't do it in a logical way. It does it in what you think is an irrational way. It just unleashes to correct itself. I think silver's in that process. And I think, if we measure from what we consider to be when the clock began for this multi-quarter surge, let's say, was November's close. That's when silver broke out versus gold, like a 10-year wide range of very low valuations, and broke out of it, and still above it, by the way. Silver's still doing better than gold. It's only, that was November close, so we start December, Jan, Feb, March, April. We're a couple quarters into it. We're arguing that in the next quarter or so, when you come out of this congestion zone, you could see the absolute parabolic move that copper produced, that lead produced, and their move to new reality. And it's up to the bears now. You either prove your case or you fail, and you got to do it like right away, like now. We'll see. If gold, for example, had come down to its 200-day average in the past couple years and held it and rallied, dropped to it, held it and rallied, then when we plot a momentum chart of gold versus its 200-day average, you would have seen two drops down to the zero line, meaning where the average is. Been above the average, or is it going to go below it? It would have held it and held it. It would have created what we call a structure, meaning a floor at the zero line, at the 200-day. We didn't do that. We just broke below it without any prior references, multi-point lows at the same average that created a structure. So it is a non-structural break of a moving average. It's not meaningful. Now, sometimes a market will set a structure at a given moving average and turn it into what we call meaningful structure. This is not. It's merely weaving a number that every guy out there knows and thinks, oh, it's the end of the world. So anyway, that's our assessment of that. The 200-day is noise. And it's good that it broke it, because that then put into the bear side anybody who was using that as their metric of, is it still bullish or not? So they're now bearish as well. Fine. Everybody's bearish almost. We're having a major asset class shift again, and the last indicator of that shift will be the downside in the stock market. And I don't expect that to become headline type nature until we get well into the third quarter. Right now, we're just setting the stage for that by wobbling off the high. I know everybody thinks a 5% drop's the end of the world. They're wrong. The S&P won't get into real trouble till we get next quarter. And I don't mean it has to crash then, but I'm just saying, where it becomes more obvious to the average Joe that, this is my RIA just dropped 20%. Anyway, that's where I think we stand. A major asset class shift. The Fed has to panic. I don't care what they say about inflation. They have to restrain it by what? Raising rates? Yet they're printing money like crazy. That's the issue. The short-term end of the market. That, remember back in 75 to 80, the Fed went berserk in raising interest rates. Even long-term bond yields, the end of the market, they don't control that much. I think short-term rates went up to 14%, okay? But the long end of the market, like 30-year bonds, went from 7.5% to 12.5%. During that late 70 period. What did gold do during that time? Exploded. Okay. Totally exploded from like $30 to 200. Okay. And yet the stock market was a wasteland. So people make mistake in assuming that, well, if Fed raise rates, that's bad for gold. And two, if the stock market goes down, that's bad for gold. They're both erroneous assumptions.
The key takeaway is that corrections are a natural feature of every major bull market. Precious metals have experienced multiple periods of sharp volatility over the last decade, yet the broader trend has remained constructive. With that history in mind, investors who understand this context are often better prepared to withstand temporary setbacks without abandoning their long-term strategy. Another important theme is the difference between momentum analysis and conventional chart-based trading. Momentum shifts can identify major changes in market direction before they become obvious to the broader public. When markets attract widespread attention after large price advances, many participants enter at elevated levels and become vulnerable during the first significant pullback. This, in turn, creates emotional selling pressure that can exaggerate short-term weakness. At the same time, the broader financial landscape remains highly dynamic. Economic uncertainty, geopolitical developments, and shifting investor sentiment continue to influence both precious metals and equities. The market takeaway is that volatility may persist. But the larger trends in gold and silver remain central to investors seeking protection from financial instability and currency risk. For long-term precious metals investors, patience and disciplined positioning remain essential. The key takeaway is that understanding where markets are in their broader cycle may be more important than reacting to every headline or short-term price fluctuation. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.